Good day, ma'am. I'm Ferlin Jane Ripal. I'm one of the reporters from Group 3, and let me introduce my co-reporters for this group. Duarme Roslyn, Gitalan Sheila May, Hetizo Gretchen, Danyat Alexander, and Capin Rothschild. So our topic to be discussed is a basic long-term financial concepts. So first we have here simple and compound interest to be, to be discussed by yours truly. Second, concepts of time value of money to be discussed by Dorme. And third is loan amortization to be discussed by Capin together with Danyot. Fourth is conventional cash flow by Gitalan. And lastly, concepts of risk and return and trade-off to be discussed of our last reporter, Miss Hetizo. So first, what is simple and compound interest? Interest is the cost of borrowing money where the borrower pays a fee to the lender for using the latter's money. The interest, typically expressed as a percentage, can be either simple or compounded. So interest is a cost of money or percentage that is charged from the lender. So meaning, kana na siyang nagdagdag bayad, nagdagdag sa bayad silbi or tubo sa imuhang kwarta nga gihuman or imong gi-invest. And mag-base na siya sa days, monthly, or weekly. And it depends sa lender nga ihatag niyang lender or sa imong gi-investan sa kwarta sa iyang ihatag nga palugit or condition of interest. Simple interest is calculated using the following formulas. Simple interest is equals to P times R times N. P stands for principal amount, R stands for annual interest rate, N stands for term of loan in years. So let's move to compound interest. Compound interest is accrues and is added to the accumulated interest of previous periods. It includes interest on interest, in other words. So compound interest is the interest on savings on both the initial principal and the accumulated interest from the previous periods. Compound interest also gani, it multiplies your money at an accelerated rate, and the greater the number of compounding periods, the greater the compound interest will be. Compound interest is interest calculated on the initial principal, which also includes all the accumulated interest from previous periods. Interest can be compounded on any given frequency schedules. From continuous to daily, annually, compounding multiplies money at our accelerated rate. So the formula for compound interest is on your screen. Compound interest is equals to P times open parentheses 1 plus R close parentheses T minus P, where P stands for principal amount, R stands for annual interest rate, T stands for number of years interest is applied. So that will be the end of my report, and thank you.
Hi, my name is Rosin A. Dormi, and now let's tackle about my report, Concept of Time Value of Money. Concept of time value of money. Time value of money. The time value of money is the concept that money available at the present time is worth more than the identical sum in the future due to its potential earning capacity. The time value of money draws from the idea that rational investors prefer to receive money today rather than the same amount of money in the future because of money potential to grow in the value over a given period of time. For example, money deposited into a saving account earns a certain interest rate and is therefore said to be compounding in value. The most fundamental TVM formula takes into account the following variables. FB equals future value of money, PV is equals present value of money, I is equals interest rate, N is equals compounding periods per year. T is equals number of years. As you can see, there is a formula of TVM. What is concept time of value? I will cite an example about concept time of value. First, personal finance. Personal finance. Money is a very valuable in terms of need. Saving money for personal uses or interests in the great benefits to them in everyday life. Money is essential like buying food, buying needs, and etc. For example, you can save 100 pesos every day. Within a month, you can have a great amount of money. Second, business operation. Money plays a vital role in business. They say money is the language is each transaction in the business. Money is a capital, an investment, a profit, an income, and also a loss in the business. For example, in investing your money for 1 year in the company that has an interest of 50% above, within 1 year you can have a big sum amount of valuable money. That's all. Thank you.
Loan amortization. Amortization refers to the reduction of a debt over time by paying the same amount each period, usually monthly. With amortization, the payment amount consists of both principal repayment and interest on the debt. Example, calculating the payment amount per period. The formula for calculating the payment amount is shown below. So this is the formula of the payment amount period. So where E equals to payment amount per period, then P is equals to initial principal loan amount, then R is equals to interest rate per period. So as you can see in the image, this is the example of the payment amount period. Number 1 is gather the information you need to calculate the loan's amortization. So we must gather the information and then calculate the loan's amortization. Number 2 is set up a spreadsheet. So in order to have a good quality of the planning, is we must have the setup of a spreadsheet. So every month, then what is the principal and the interest payment, the principal payment and the ending principal. So we must record every single to the spreadsheet. That's all.
Good day everyone, I'm Daniel Alexander and I will discuss the spreadsheet. So set up
a spreadsheet. So sa spreadsheet, makita mo ang month, principal, interest payment, principal payment, and ending principal. So ang month is kato ng inyong monthly payment or number sa month nga pila to nimo kaman siya in peso. So principal is the amount nga gi-borrow ninyo sa lenders. Total amount nga gi-borrow. So interest payment. So interest payment is kato ng payment ninyo nga gibayad ninyo ang payment niyo sa interest nga gi-borrow ninyo sa inyong lenders. Walay labot ang principal. So ang interest is ang kato lang interest ang inyong gibayaran. Ang principal payment is kato ng payment niyo sa money nga inyong gi-borrow. Walay labot ang interest. Ang ending principal is kato ng balance nimo sa within the month nga nabayaran nimo or balance remaining balance nga imong utang. So next page, calculate the interest portion of the monthly payment for month 1. So dali makita nimo is among ditong example is 100,000 ang principal. Unya 6 years or 360 months ang time nga or ang duration sa ilang pagbayad or sa payment. So pag-calculate mo sa interest payment is 100,000 times 0.005. Anong 0.005 man kay diba makabutan dito sa mga example is 6%. So ang katong 6% is i-divide mo man ito ng 12 kay monthly man ang imong pagbayad sa imong gi-borrow nga money. So 6% divided by 12 is 0.005. So 0.005 times 100,000 is equivalent to 500. So manang interest payment. So sa principal payment, pagkuha na sa principal payment is imong i-subtract ang katong monthly payment nimo sa imong interest payment. So ilat mo sa example is 599.55 per month. So i-minus mo sa interest payment. So ang result ana is 99.55. Ang kanang 99.55 mo na imong principal payment or ibayad mo sa imong utang. So sa next page, use the new principal amount of the use the new principal amount at the end of the month. Want to calculate amortization for month 2. So sa principal ending, ang pagka sa principal ending is sa principal ending is 100,000 minus sa principal payment nga 99.55. So ang result is 99,900.45 dollars or euros mundo. So dito ang imong principal or new principal diri is 99,900.45 na lang. So mao lang gyapon ang cycle or mao lang gyapon ang formulation nga imong gamiton. Principal. So ang pag-calculate na gyapon mo sa interest payment is mao ra gyapon like diba diri is kuha na 99,900.45 times 0.005 gyapon. So ang result niya is 499.5 or 0.50. So muna na imong ibutang sa interest payment or mga imong bayad sa interest lang na siya, dili na siya sa kunay labot sa principal. So next is principal payment. Mao na gyapon ang kumaagi sa akong una. So nanakay 100 ray 100.05. So minus gyapon mo sa katong 99.900.45 sa 100.05. So ang result is 99,800.40. So inanaw na siya, balik-balik rin ako na siya, abot mo sa third month, mo ra gyud punto nga equation ang gamiton. So additional ka na ang imong column nga pila ka months ang kiningibutan nimo dili lang ka 1 or 2, so 360 man to siya. So maghimo kag 360 ka buok nga ani nga columns or so siya para makita gid nimo ang total nimo nga nabayad or bayro nun. So that's all. Thank you.
So, good day everyone. I am Sheila May Bigitalan and I am here to report about the conventional cash flow. So first, what is conventional cash flow? So conventional cash flow is a series of inward and outward of cash flows over time in which there is only one change in the cash flow direction. So just like this example on the next slide. So as you can see, a conventional cash flow for a project or investment is typically structured as an initial outlay or outflow. So kanang 10,000. Muna initial outlay or outflow sa business nila. Nya followed by a number of inflows over period of time. So inflows kanang wala na sila nagpagawas og kwarta kaisa ra jud mo na conventional cash flow. Kaisa ra ma-change ilang direction sa cash flow. So, conventional versus non-conventional cash flows. A project or investment with a conventional cash flow starts with a negative cash flow, of course, the investment period. So, need mo jud ka mo-invest ana. So, para makagain sa kagkuan ba? Profit. So, need sa ka mo pagawas og money. Maunang initial period or the investment period, followed by successive periods of positive cash flows generated by the project once completed. So, followed by kanang inflows na kanang mga 2,000. So, the rate of return from the investment or project is called the internal rate of return or the IRR. So, conventional cash flows have only one internal rate of return or the IRR, which should exceed the hurdle rate or minimum rate of return needed. So, i-compute ganila sa kay isa ra man sa dilang outflow, isa ra sad ang needed na IRR nila. So, i-compute nila sa kuan dapat mo exceed siya ang hurdle rate sa minimum rate sa needed na return nila. Ang sud na kwarta nila. So dapat mo exceed siya sa kanang outflow na kwarta. So na-exceed ba? Na-exceed. So mao na ang conventional cash flow. While unconventional cash flows have multiple outlays of cash over a project's life, and as a result, multiple IRRs are needed. So, diri sa non-conventional cash flows, kadaghan sila mapagawas og kuan money or cash. Kadaghan sila magkuan ma-undergo og cash at outflows. Okay, let's say for example, ni-invest sila or na sila equipments na kanang bayaran sa initial na investment or initial na kanang outflow nila sa ilang business na sila gibayaran na kanang equipments niya after 5 years ana there is a need for an upgrade sa equipments ni sa business. So need na sad ka mapagawas og or need na sad ang business mo pagawas og money, which is the cash outflow. So ang mahitabuan na kay kaduha man siya nagpagawas og money, kaduha sad siya magkuan sa ilang IRR. So bali duha ka IRR ang needed. Mao nang multiple IRRs are needed in non-conventional cash flows. So in simple words, unconventional cash flows have more than one cash outlay or investment, while conventional cash flows only have one. So kato akong example na kaduha sila magpagawas og money. Sorry guys, I'm not feeling well. So two rates of return for a project or investment can cause decision uncertainty for management if one IRR exceeds the hurdle rate and the other doesn't. So mao na ni ang problema sa unconventional cash flow. If ang isa ang kuan mo sa IRR sa first na pagpagawas ni money kay kuan ka nang ni-exceed siya sa hurdle rate nya ang second kay wala dira na maproblema na mo ana kay kuan complicated jud kay ang non-conventional cash flow. Now if there's uncertainty surrounding which IRR might prevail, management won't have the confidence to go ahead with the investment. So, mawagtangan na jud gana ang mga kanang lain na businessmen na kanang willing ta mo invest sa imong project or imong business. So, magtangan na sila gana. Kay kuan man kanang kuan kanang daghan kay IRR, nya nagka problema pa jud. Ang isa kay wani exceed sa hurdle rate. So, magtangan na sila gana. So, cash flow is the net amount of cash and cash equivalents being transferred into and out of a business. Hence, it is very important. So, that's all for my report. I hope you enjoy. And thank you and God bless.
So, for the last subtopic of the basic long-term financial concept is the concepts of risk and return and trade-off. So, here we have the concepts of risk and return. So, first here we have the risk. Risk in investment from investors' view implies that the actual return may not be as expected. From the point of view of a firm, when the actual return is not the same as estimated, it is considered as risk. The higher the variations in results, the higher is the risk, and vice versa. So, business risk can be defined as uncertainties or unexpected events which are beyond control. In simple words, we can say business risk means a chance of incurring losses or less profit than expected. These factors cannot be controlled by the businessman, and this can result in a decline in profit or also can lead to a loss. So next, we have the different types of risk involved in investments. There are three. One is capital risk, two is income risk, and three is the default risk. So first we have capital risk. It refers to a capital loss because of fall in the marketplace of a security like equity. So capital risk is the possibility that an entity will lose money from an investment of capital. Capital risk can manifest as market risk, where the prices of assets move unfavorably, or when a business invests in a project that turns out to be a dud. In the financial world, risk refers to the chance that an investment's actual return will differ from what is expected, like the possibility that an investment won't do as well as you'd like, or that you'll end up losing money. The most common example of capital risk is seed funding for a business. Like when a business starts up its operations, it requires a certain investment. This investment cannot always be supplied simply through loans from banks, but also requires investors who believe the business will make money. So the second type of risk is income risk. It refers to variations in return from a security. So the possibility that a portfolio's dividends will decline as a result of falling interest rates. It is generally greatest for money market instruments and short-term bonds, and least for long-term bonds. The risk that the yield of a fund investing in short-term debt securities will decrease because of a decline in interest rates. For example, suppose a mutual fund invests in money market securities with maturities of less than a year. If interest rates decline, then the yield on the money market fund will also decline because when the money market securities mature, the returns are reinvested at lower interest rates. Income risk is the same concept as interest rate risk, but the former applies to funds while the latter pertains to individual debt securities. For example, consider a mutual fund that invests in money market securities with maturities of less than a year. If interest rates decline, then the yield on the money market fund will also decline. Like when the money market securities mature, the returns are reinvested at lower interest rates. And the third type of risk is the default risk. It refers to default in payment of interest or repayment of the principal amount by the company. So, default risk is also called as default probability, which refers to the risk that a lender takes on in the chance that a borrower will be unable to make the required payments on their debt obligation. Lenders and investors are exposed to default risk in virtually all forms of credit extensions. It is probably that a borrower fails to make full and timely payment of principal and interest according to the terms of debt security involved. Together with loss severity, default risk is one of the two components of credit risk. In assessing default risk, while it is often useful to consider the whole distribution of potential losses and the respective probabilities, it is generally convenient to calculate a simple indicator of risk that considers a single default probability and loss severity. The indicator is called expected loss and can be calculated as follows. You only have to times the default probability by loss severity, then that will equal to the expected loss. For individuals, lenders will often look at a borrower's credit score to determine the individual's level of risk and what kind of interest rates they should qualify for. A credit score is a three-digit number that evaluates how likely you are to repay your loan and make your payments on time. Your credit score is calculated based on the information in your credit report. This includes your payment history, the number of accounts you have opened, and your overall debt levels. So next we have the return, which means the motivating force and the principal reward in the investment process. A return, also known as a financial return in its simplest terms, is the money made or lost on an investment over some period of time. A return can be expressed nominally as the change in dollar value of an invested over time. A return can also be expressed as a percentage derived from the ratio of profit to investment. Returns can also be presented as net results, like after fees, taxes, and inflation, or gross returns that do not account for anything but the price change. A return is the change in price of an asset, investment, or project over time, which may be presented in terms of price change or percentage change. A positive return represents a profit, while a negative return marks a loss. Returns are often annualized for comparison purposes, while a holding period return calculates the gain or loss during the entire period of an investment that was held. The real return accounts for the effects of inflation and other external factors, while the nominal return is only interested in price change. The total return for stocks includes price change as well as dividend and interest payments. So, return can be realized or expected. So, return have two kinds. We have realized return, which means or refers to the return which was earned or could have been earned, and the other one is expected return, which refers to the return which the investor expected to earn in the future. So, realized return refers to a return achieved in the past, and expected return refers to an anticipated return over a future period. A required return is the minimum level of expected return that an investor requires to invest in the asset over a specified period, given the asset's riskiness. A realized return is the amount of actual gains that is made on the value of a portfolio over a specific evaluation period, and the return that is actually earned over a given time. While expected return, it refers to the return, either profit or loss, that an investor expects on an investment, which is determined by the anticipated rates of returns. Investors can determine the expected rate of return by multiplying the likely outcomes of the investment by the probability of the outcomes occurring. In the case of an investment portfolio, the expected return is determined by matching the weights of the investments with the anticipated returns. An investor's expected return is the total amount of money they expect to gain or loss on a particular investment or portfolio. The common purpose of an expected return for investors is to help them make key decisions on whether to invest in new vehicles or continue to hold on to their existing investments. So how does expected return work? The expected return is an important metric that determines whether an investment will be profitable or otherwise. The average net outcome of an investment is also determined, which can either be positive or negative. It is important that investors assess the expected returns of investment as well as the probability of return, which will give an insight into the underlying risks of the investment. So next we have here. In concept of risk and return, return always comes in the given forms. So first, the investor should get safety on the investment that he has invested. So of course, investor protections matter for the ability of companies to raise the capital needed to grow, innovate, diversify, and compete. Without investor protections, equity markets fail to develop and banks become the only source of finance. Economies that have dynamic capital markets tend to protect investors effectively. Diversification, for example, is the key to protecting yourself as an investor against major losses. For example, if you make a few high-risk investments in some of the new technology startups, you should also make investments that are lower risk to help offset potential losses. The great examples for this is the bonds, CDs, annuities, and mutual funds. So the second one is there must be hassle-free deals should be available to the investor in buying and selling of his investments. So of course, for convenience of the investor, it's a good thing, and it should be available, the hassle-free deals, so that it would be easier for the investor to buy and sell their stuff in the marketplace. So the third one is the investors should get liquidity on their investment. So liquidity is important in investing to be able to access the wealth that you build. If your assets are all tied up in a long-term investments or highly illiquid investments, you may find yourself cash poor. This can significantly reduce your ability to direct funds into an investment opportunity that comes your way. So your investment strategy should include maintaining a certain level of liquidity. And the fourth one is there are possibilities for funds appreciation. So it is growth in the principal amount invested, but not necessarily an increase in the current amount or current income from the asset. In the context of investment in a mutual fund, capital or fund appreciation refers to a rise in the value of securities in a portfolio, which contributes to the growth in net asset value. So it also refers to an increase in the value of an asset over time. So the increase can occur for a number of reasons, including increased demand or weakening supply, or as a result of changes in inflation or interest rates. This is the opposite of depreciation, which is a decrease in value over time.
Risk-return trade-off. What is the risk-return trade-off? The risk-return trade-off states that the potential return rises with an increase in risk. Using this principle, individuals associate low levels of fund uncertainty with low potential returns and high levels of uncertainty or risk with high potential returns. According to the risk-return trade-off, invested money can render higher profits only if the investor will accept the higher possibility of losses.
So that would be all for our discussion of the basic long-term financial concept. We are the Group 3, and God bless. Thank you so much.